Chapter 11.3, Journalizing the Declaration and Payment of Dividends. Some terms that we want to just kind of cover before we go in there. Retained earnings. Retained earnings is when a company has a profit and therefore their earnings, they decide to hold on to their earnings. A lot of times companies can take their retained earnings, and if they want to, and they're feeling generous and they want more people to invest in their company, they can offer dividends. In order for a dividend to be offered, you have to have a board of directors, which is basically the CEO's boss, and they will have to approve declaring a dividend. So we'll talk about how you declare a dividend, and then we'll also talk about the actual paying of the dividend. So in this transaction, we want to talk just real quick on our stockholders' equity. Up until now, since we are dealing with previously we've been dealing with a sole proprietorship. So you only really had two accounts. You had owner's equity capital, you had owner's equity drawing. Now we have capital stock, retained earnings, dividends, and income summary. Capital stock is it's what the value of the company is. Retained earning, as we talked about, that's when you have profit that you decide to hang on to, and dividends is when you decide to issue your owners, in a sense, the stockholders, a incentive to keep buying your stock and hanging on to your stock. For all intents and purposes for this lesson, we're going to talk about the dividend being cash. There are different forms of dividends that can be offered, but we're not going to go into those. Income summary, you don't have to worry about that. You might remember it back in the first chapter when we closed all our accounts. That's just our little quirky bird that we use to close accounts. We won't worry about that. Board of Directors, December 15th, Board of Directors declared a dividend of $1.50 per share. Capital stock issued is 2,100 shares. Memorandum 258. So in order to figure out the amount of this transaction, what we need to do is we need to know the number of shares outstanding times the dividend per share, and that'll give us our total dividend. In this case, our total of shares outstanding is 2,100 shares. The dividend per share, as the transaction says, is $1.50 per share, for our total dividend being $3,150. So we're going to use our two accounts, and it's basically going to be our dividends account. And again, that's our owner's equity account. Dividends is lowering the value of the business because it's money going out, if you think of it that way. And then we're going to do dividends payable. And the reason it's dividends payable is because we have not paid it yet. We just declared it. But until we pay it, then we will there. And again, that's going to show an increase there. So basically, our $31.50 is going to go into dividends. We declared $31.50, and we have a $31.50 balance. So if you think about it this way, we're saying, yep, there's going to be $31.50 coming out of the business, going to lower the worth of the business in the owner's equity in the shape of a dividend. And then also, yep, we owe our owners $31.50 in a dividends payable. Transaction operates the same way. December 15th, enter the debit first. Dividends, doc number in this situation is M258. General debit of $31.50. Dividends payable is going to be our credit $31.50. So then after we've declared the dividends, and the next step, and it doesn't happen right away, might take 15 or so days or a couple of days, whatever, but usually by the end of the month, or month period, hopefully sooner than later, we have to pay cash. So this is the second part of the dividend. So the first part is declaring, this part is paying cash. So basically we take our same transaction, we know that we owe all of our owners, our stockholders, $31.50. So we have to pay them. So what we have to do is we have to zero that dividends payable with a debit, and we're going to credit our cash $31.50 because that is how we're going to pay it. And again, we are assuming that we are paying cash for this dividend. There are other methods of paying dividends, but for all intents and purposes, we are going to say that we are paying cash for this. So we then go to our cash payments journal because we are paying cash. We are going to use our cash payments journal. The date of this transaction that we are paying cash, not the date of the transaction where we declared the dividend. The date of the transaction we pay in cash is going to be on January 15th. We are going to be debiting our dividends payable. We're going to be writing check 721, and we are going to write a check out for $31.50. That is how you declare dividends and pay dividends for a business that has for a corporation that has multiple owners, aka stockholders. Hope this helps. If you liked it, if it does, like the video. If it really does, feel free and subscribe. Love seeing you here more often. See you in class.